there's not a lot to study from a macroeconomic point of view in the week ahead. The UK GDP growth number on Tuesday the 11th of February is by definition backward looking and therefore not much use to forward looking financial markets. But if you're really keen on the top down stuff, then you might want to also watch for the UK's monthly industrial production numbers on the 11th, America's NFIB Smaller Companies Business Confidence Survey, also on the 11th, US inflation figures on the 13th and US retail sales data on the 14th. Well, they're all relatively unlikely to be market moving unless US inflation shows an unexpected increase, so we'll dive straight into the company news this week. A fair number of FTSE 100, FTSE 250 and small cap firms are due to release results, a trading statement or host their shareholders' annual general meeting in the week ahead, and some of the more informative updates could come from the following. Ocado, travel agent TUI and small cap motor and bridging finance lender S&U on Tuesday the 11th. Retailer Dunelm and support services specialist Babcock on the 12th. The latter is still looking to recover from last year's critique by short-selling hedge fund Boatman Capital. Barclays then kicks off the quarterly reporting season for the big five FTSE 100 banks on the 13th, when Centrica and Coca-Cola HBC also report. And to close, we've got real estate investment trust Segro and Royal Bank of Scotland on February the 14th, Valentine's Day no less. Now, as we can see here, the FTSE all-share banks sector is still languishing despite lowly valuations relative to stated book value and in some cases some fat yields. So it'll be interesting to see if Barclays and RBS can conjure up a bit of love for themselves. Sorry about that. But for all of that, the stock which might just cause the biggest fuss in the week ahead is AstraZeneca. It's scheduled to report full year results on Friday the 14th of February, just a week after fellow FTSE 100 pharmaceutical giant GlaxoSmithKline. Now, in contrast to the banks, which rank 32nd out of 39 sectors within the all-share over the past year, pharmaceuticals and biotechnology ranks 4th with a capital gain of 27%. AstraZeneca is a big factor behind that strong showing, and Chief Executive Pascal Soriot will see the firm's share price rise as ample justification for the board's decision to reject the 2014 bid from America's Pfizer, which came at £55 a share, about a third below where we are now. Now, after a very busy period of merger and acquisition, M&A activity between 2006 and 2013, which did little to replenish the company's pipeline of new medicines, Monsieur Soriot introduced a new strategy when he took over in 2013. AstraZeneca would, to use his words, focus on scientific leadership and return to growth, as well, I should stress, as be a good place to work. Now, this means the firm is focused on new drug development and research. Much of this has been done through the R&D budget internally, although deals have supplemented this activity, notably Acerta and ZS Pharma in 2015, a collaboration in oncology with America's Merck in 2017, and 2019 $6.9 billion cancer drug rights deal with Japan's Daiichi Sankyo. The result is that AstraZeneca's pipeline of new treatments in its core areas seems to be blossoming. And remember that those core areas are oncology or cancer, cardiovascular, renal and metabolism, and respiratory. We can see here how the pipeline shapes up in terms of the number of new products that are in phase 1, 2 and 3 trials, or in what's known as LCM, life cycle management, which means they may be in late phase 2, phase 3, or even moving into sale. Now, in addition, AstraZeneca does seem to be returning to growth, especially as it raised its revenue growth outlook for 2019 twice last year at the second and third quarter stages. The full year results that we're about to get will therefore be judged against those increased expectations and also any guidance that Monsieur Soriot gives for 2020. Now, the first number to watch therefore is total product sales. We can see by the year-on-year growth rate in this chart going back to early 2015 that the trend has been one of steady acceleration in both stated and constant currency terms. Next factor to watch is what the company calls core earnings per share, or EPS. This excludes quite a lot of accounting items. Some of you may see that like the company marking its own homework, as the statutory or stated EPS figure will be audited and has been coming in consistently lower. This chart shows both numbers going back to 2010, core and stated, and you can see the gap is quite wide. For the record, the consensus earnings per share forecast for 2019 is $2.77. It's down from last year, $3.46. and the 2020 estimate is $3.30. Finally, analysts look at the dividend. The company switched from paying in pence to dollars 3 or 4 years ago, since when the annual payout has been $2.80 a share, roughly 215 pence at current level exchange rates. Now that's enough for a dividend yield of about 3%, and also means that AstraZeneca is the 7th biggest dividend payer in the FTSE 100 in cash terms. Analysts expect an unchanged distribution of $2.80 in 2019 and 20, but this chart shows the dividend in pence for ease of comparison with the pre-2016-17 figures. Now, AstraZeneca's policy is to maintain or grow that dividend, though some analysts do point out that earnings per share only cover the forecast payment by around 1.5 times, which is a bit lower than ideal. In addition, free cash flow cover is skinnier too, so it'd be nice to see some growth here to give scope for dividend increases, or even make sure the current forecast payment is totally safe in the event of any unexpected setbacks. Thank you for watching, and I look forward to seeing you next time.